Thank you, Helena, for that introduction. And I just want to make sure that the slides are coming up. Oh, here it comes. So thank you very much. If we could just jump right into this, because we've got a lot to cover today. Welcome, everyone. Before we get into the panel with our fantastic guests, I will provide you with a quick background on why climate risks and accounting, how they interact and why it's important. I'll talk to you about quickly the work that we're doing in this space, such as the Flying Blind report that we wrote. I'll discuss some assessments we did of Chevron and Exxon's financial statements and their responses to shareholder resolutions. And then we'll talk a little bit more about the shareholder resolutions in the panel, and we'll have some time at the end for some audience Q&A. So if we move along to the next slide. First, I just want to talk briefly about why accounting matters. Many of the numbers in the financial statements today are already based on estimates and assumptions about the future, such as projected demand, projected production, or forecasted or projected prices. These are items that can already be materially impacted by climate-related issues today. These issues can include emission reduction policies, emission regulations, and so perhaps increasing carbon prices, declines in demand, and so declines in commodity prices, or even phase out of products because of disruptive technologies such as the use of electric vehicles or renewable energy, and so declines in production. So the estimated cash flows that are used in assessing asset impairments and so asset valuations will be and can be significantly affected by these types of items, these policies, regulations, changing demand, or changing consumer preferences. This means that there could be asset impairments as a result. This could mean also shortened asset lives and so early asset retirements, which could mean those asset retirements are accelerated, and cash flows the cash flows the company intended to use to cover those may change. There could be contracts that have prices that are locked in that could become unprofitable in the face of the energy transition. There could be an increase in potential credit losses from lending to these types of companies. So all these factors, this is not an exhaustive list, but all these factors can in turn impact expected profitability, which can then impact investment decisions both from the company and for investors, as well as management compensation. If financial statements ignore the impacts of material related issues, this can misinform shareholders and then result in the misallocation of capital. So if we want to deploy capital effectively, we need to reflect fully material climate impacts in financial statements today, and auditors need to assess them. If we move to the next slide, there's been growing interest in this area in climate related matters and financial reporting over the past few years. We've had standard setters, both internationally, so IFRS accounting standards, and in the US, so US GAAP, clarify that these matters are required to be considered when preparing financial statements. So material climate-related matters are already relevant for accounting requirements today. The global audit standard setter has also reminded auditors that these material climate-related risks fit in with audit responsibilities, and so auditors must also consider these issues in their audits. These are for international standards on auditing, but the US audit requirements do not significantly differ. And so we would expect auditors to be considering these as well. Investors have expressed publicly the importance of this information to their understanding of climate change and energy transition on a company's financial statements. And this can impact their capital at risk. They need to understand this to understand if there are potential losses. They also may need to understand this to address their own remits for addressing the energy transition or achieving net zero. For example, last year, or actually now in 2020, investors representing over 100 trillion in assets under management have requested that management and auditors consider these issues when they're preparing financial statements. So consider the impacts of material climate-related risks when preparing and auditing financial statements. Other investor groups such as the IIGCC or investors such as Saracen have been writing ongoing letters to specific companies about these issues. These investors have also requested what they call sustainable assumptions or Paris-aligned assumptions in accounts. So even though this is not required today, they need to understand how a company is resilient to, or perhaps not resilient to, the movement to a low carbon economy. We're also seeing an increase in market regulators in their review and oversight of these issues. For example, the UK Financial Reporting Council has looked at these issues over the last few years. The European Securities and Markets Authority are going to include consideration of these issues in their reviews of 2021 financial statements. And the SEC has published a proposed climate-related disclosure requirement that would be including required disclosures or reinforcing requirements that are already in for financial statements under US GAAP today. We're continuing to speak to regulators about our findings in these areas and the need for better oversight and disclosure in financial statements today. And finally, we're actually seeing that companies are appearing to increase at least their acknowledgement of these issues in their risk factor discussions outside of the financial statements and in other reports such as sustainability reports, which you'll also see when we talk about Chevron and Exxon's response later on. If we move to the next slide, I wanted to highlight a little bit of the areas that we do look at, again, when we are assessing companies for consideration of these issues. We highlight 3 areas in our reviews. We look at financial statements, which include the notes to the financial statements. We look at whether companies have demonstrated the material impact of consideration of the impact of climate matters when they're preparing their financial statements. So do they explain how climate-related risks or targets have been considered, as I mentioned in the previous slide, the financial impacts of those and how they have impacted the assumptions and estimates such as useful asset lives, such as future prices, such as future costs in their asset valuations today and related liabilities. We look also to see if companies have disclosed quantitative climate-related assumptions and estimates. So these are assumptions and estimates that they're already using today to prepare their financial statements, and that would be materially impacted by climate-related issues, such as oil, gas, and carbon prices. These are also required to be disclosed today under both international and US GAAP, especially if there are items such as asset impairments. We also look to see if companies are telling a consistent narrative. So if a company is discussing the potential for climate-related risks, such as changing regulation, changing consumer preferences, or even their own emissions targets, does it appear that they've considered these issues when they've prepared their financial statements, again, on the assumptions they've used, and including, for example, how they might achieve their emissions targets and the impacts on existing asset lives. We also look at the audit report, to look at how the auditors have assessed these matters. Now, auditors, as I mentioned, are required to consider material climate-related matters in their audits. And they, as part of their audits, identify key or critical audit matters. And these relate to items that are subject to significant judgments or estimates, and so could be subject to material misstatement. So based on the types of items that auditors identify, such as impairments, we would expect that climate and transition-related risks could materially impact these items, the adjustments, the assumptions that are included in a company's impairment assessment. Auditors are also required to check other information for consistencies with the financial statements, so we also look at this. And finally, as I've mentioned, investors have requested that companies provide assumptions and estimates that are what they're calling sustainable or Paris aligned, but they've clarified, they're clear that these would be assumptions that are aligned with achieving net zero emissions by 2050 or sooner and on a no more than 1.5 degree warming pathway. They've also asked auditors to assess this or to perform their own sensitivity to these inputs. So again, we understand that this is not required today, but investors have asked companies to assess this information because it's important for investors to, as part of their understanding of a company's resilience to these issues. And when we assess for this, we currently use the IEA's net zero by 2050 scenario to assess this. If we move to the next slide, we've already looked at companies and published results of these assessments, such as our report called Flying Blind, as Helena mentioned in the beginning. We're also doing a climate accounting and audit alignment assessment for the CA 100+, and we published fiscal year 2020 results in March 2022. Both reviews or assessments, we have been looking at over 100 companies, and many of the companies overlap. Most of the companies are operating in carbon intensive sectors, such as the energy sector, such as transportation sector, such as industrial. So they would already be subject to the impacts of climate and the energy transition. And we knew that these risks would be material to them. However, unfortunately, there's been little consideration or evidence of consideration of these risks for the companies and their auditors. And we've presented, like I said, the results in our reports. You can also see the result of our assessment for March 2022 on the CA100 website. And we'll be updating the results of that, the CA100 Plus assessment, later this year for fiscal year 2021 financial statements. So if we move to the next slide, we'll getting into the meat of this webinar and looking at Chevron and Exxon. So in addition to the CA100 Plus assessment that we performed, that was published in March, we also started looking at 2021 financial statements, and we did some target assessments for a group of companies that had been identified by investors for engagement with those companies. And those companies include Chevron and Exxon. So we started already to analyze their financial statements for 2021. We see effectively no evidence of consideration of climate-related matters in their financial statements. There's been a slight improvement in their disclosures. Chevron talks about carbon costs and the pace of the energy transition, and that these items could impact asset impairments. Exxon talks about consideration of greenhouse gas emission prices in its impairment testing, but they don't provide any information as to how any of these items were considered, and so whether they impacted any of the asset impairment tests that they have done, or, for example, calculations of asset retirement. Neither have disclosed the relevant inputs that we look for that would be materially impacted by climate, such as oil and gas prices or carbon prices that they use in their financial statements. Again, even though these are required under US GAAP SEC rules, especially because they did have impairments in fiscal 2021. Exxon does provide a carbon price that it uses in its outlook, but it is not clear, and that's outside the financials, and it's not clear if that price is used in preparing the financials. Both also discuss climate-related risks in the front of their US filings, the 10Ks, and in sustainability reports, and they also have some net zero aims and some interim targets. They also talk about the use of carbon capture and storage and offset. Exxon also discusses its belief that hydrocarbon demand will increase, but it also does talk about risks. However, as I mentioned, none of this information is evidence there's no evidence of whether these companies have considered this information, such as an impairment assessments, impacts on useful lives, acceleration of their decommissioning obligations in their financial statements, and so their climate narratives appear to be inconsistent. If we look at the auditor, they're both audited by PwC, which identified the same critical audit matter for them, which would be the impact of oil and gas natural reserves on upstream property, plant, equipment, proved oil and gas reserves. And we note that these reserves could be materially impacted, again, by climate issues, such as reduced demands for the product, which could lead to declining prices, increased costs, especially if these companies need to pay for carbon capture and storage to continue to use these assets. All these would impact the company's ability to economically produce these resources, and this could lead to shortened asset lives. However, PwC does not talk about these items in its assessment of this critical audit matter. It only briefly mentions that carbon costs are a variable for Chevron. And finally, looking at, again, the net zero discussions, Exxon was clear that the prices that it used in its financial statements did not align with net zero by 2050. Neither of the companies provided any information about the oil and gas prices that they used or carbon prices, so we could not assess any alignment with IEA net zero 2050. They did not provide a quantitative sensitivity of these items. And you'll see that as I talk about the resolutions. And again, this is particularly important, especially for companies like Exxon that believe they will continue to produce hydrocarbon, so that investors can assess, again, the impact of the energy transition on these companies. PwC made no comment regarding the drive to net zero and did not provide its own sensitivity, as investors have asked. So if we move to the next slide, this slide recaps the assessments of these companies, as I talked about just now. Effectively, the lack of transparency about the relevant climate-related assumptions and estimates that they use, including, again, oil and gas prices, carbon prices, asset lives, means that investors cannot understand the extent to which they have considered climate-related issues in their financial statements today. And so they cannot assess their resilience to the energy transition, make their own adjustments as they deem necessary, and effectively engage. And again, ignoring the effects of material climate-related issues could lead to misstatements in financial statements. So there could be overstated assets, understated liabilities, overstated profits, and continued investments in non-sustainable activities. This could lead to a loss in investor capital. And of course, it could also mean that the chance of achieving our goals of achieving the Paris Agreement decline. Before I talk, if we move to the next slide, oh yes, we have that. Before I talk about the resolutions or our study of the resolutions, I want to highlight that there are other oil and gas companies that have provided better information than Exxon and Chevron. They've provided different levels of content. Here you can see that these companies have provided the quantitative oil and gas prices that they've used in their financial statements. And again, these are across jurisdictions, so in the US as well as outside the US, in the UK and the EU. In addition, in 2021, we noted that companies have started to provide sensitivities to using net zero by 2050 assumptions and estimates. And we've seen that so far for Eni and Equinor. So we're seeing a lot better information than Chevron and Exxon in their peers already. And if we move to the next slide, what I've done here is excerpted Chevron's resolved clause, which we will come back to, along with Exxon's resolved clause, which is on the next slide. We're going to talk about both of those in the panel discussion. So this is Chevron's resolved clause. We can move to Exxon's resolved clause. It's just to show it really briefly to participants, but again, we will go back to this when we are on the panel. I'll put these up again. So in response to the investor resolutions in their 2020 proxy statements, Chevron, or in its 2020 proxy statement, Chevron indicated that it had substantially addressed this request, the shareholder request, in its climate change resilience report. Exxon indicated that it responded to the resolution in its Advancing Climate Solutions Progress Report. So as I noted, as part of our assessments of the fiscal year 2021 financials, we studied both of these companies' reports to see if they indeed did appear to address the resolutions. And we do not believe that they did meet the resolution's requests. So overall, these resolutions ask for either the dollar amount difference between the commodity and carbon prices that these companies use in their financial statements and those that are used in the IEA net zero, or, like I said, the actual assumptions that they've used in their financial statements. And the resolutions are asking for the quantitative dollar impacts of using the IEA net zero assumptions and estimates on remaining asset lives, asset impairments, and asset retirement obligations today. So the impacts on the balance sheet today. Now, when we looked at the reports, we noted that the companies provide various descriptions of how their portfolios may change in the event of a net zero by 2050 scenario, and how they would have to shift to lower carbon business. They talk about potential investments in renewable and low carbon energies and low carbon technologies in the future, and reduced reliance on oil and gas in the event of a net zero by 2050 scenario. But by doing this, Chevron and Exxon are providing a mix of current and future impacts on their financials and on their business, which is more like a scenario analysis and not a sensitivity analysis. A sensitivity analysis would provide the impacts of applying a net zero input today on an existing asset or liability balance so that investors can understand the impacts on the existing capital invested today, potential for loss, potential resilience. Additionally, neither report provides any quantitative information. So either from a dollar price, production, or impairment standpoint, that would answer the request, and that would provide shareholders with an understanding of the inputs that these companies use in the financial statements. Again, the dollar impacts on financial statements. Again, the potential capital at risk, and so would help these investors effectively engage with these companies. So there's no dollar quantitative information on whether existing assets and liabilities would be, existing assets would be impaired, today under an IEA net zero 2050 scenario, or whether asset retirement obligations would be accelerated, or whether asset lives would be shortened, or units of production. And again, the companies don't provide their own inputs to even allow investors to perform their own sensitivities. Moving on to the next slide, these last two slides that I have are providing examples that we found in these reports. And there are many examples that we could reference. And there's more information in the Chevron and Exxon accounting assessments that we've done in tables in their appendices that you can find on the company profiles section of our website. But for this slide and the slide for Exxon, I've included various excerpts from their responses in their relevant reports and why they don't meet the shareholder request. And you can see I violated the simple rules of making slides simple, and I've packed a lot of text here, but I wanted to make sure I've provided you with various examples and various excerpts from the company's response, the responding report. And again, you can see how here Chevron's provided a general discussion of how its focus and of how its focus and investments could shift away from hydrocarbons and to its new energies portfolio. But it doesn't provide quantitative dollar impact on existing assets, and so the capital invested today and related retirement obligations. It doesn't provide estimated changes, again, to units of production, revenues and costs, and whether asset retirement obligations could be required for its existing refining assets. It also talks about the question of stranded assets, and it references reserves that are defined by the SEC, and the related SEC disclosure requirements. But these dictate the price a company must use to facilitate disclosures for comparability with peers, which is called the standardized measure of oil and gas, or the SMOG. This is not an impairment test. We talk about this on our website in a blog. And so the price that Chevron has provided in this report is one that's dictated by the SEC just to provide comparable information. There's no indication that this price is the one that Chevron uses in its impairment tests in its financials. Finally, Chevron indicates that its oil and gas and carbon prices are proprietary information, but we've seen that other oil and gas companies and its peers disclose the quantitative inputs that they use in their financial statements, so that belies this argument. And Chevron also references carbon costs or regulations in jurisdictions that it would be referring to, and these would be public information. If we move to the final slide in my presentation, this is Exxon, for whom we had similar concerns and conclusions. Again, I've provided a lot of detail on this slide for you. Exxon, like Chevron, provided a qualitative indication of direction of impact, but its modeled assumptions assume same market share for its new portfolio. And this does not address any impacts on existing assets or provide a sensitivity of existing balance sheet items under the IEA net zero 2050. So similar to Chevron, again, it did not provide the dollar impacts or potential impairments on existing assets, did not provide the dollar impacts, potential impacts on asset retirement obligations, or whether there would be new ones required for refining assets, did not provide estimated impacts of increased abatement or CCS costs. And it did not, again, provide the oil and gas or carbon prices that it used in its financials. So by not providing these quantitative inputs that they've used in their financials, both Chevron and Exxon are simply depriving US investors with information that they need to perform effective assessments of these financial statements and make comparisons across companies. So this is the end of my presentation, and now we're going to go on to a panel discussion. And I will be joined by Julie Tanner and Danielle Fougere. Julie is a managing director at Christian Brothers Investment Services, just CBIS. CBIS is a socially responsible investment firm that started in 1981 with 10 billion assets under management. And it's the lead filer of item 8, the report on the scenario analysis for Exxon. Danielle is the president of shareholder representative, as you sow, and the lead filer of item 6, impacts of net zero 2050 scenario at Chevron. I've included their email addresses on the slide for the panel discussion, and we can go back to that later. And I've also excerpted Next slide. There we go. Thank you. I'll just keep them up for a minute while we talk, while I ask a few questions, and then we can take them off and we can see the panelists. So it's my pleasure to have Julie and Danielle here today. Thank you again for joining us. Really appreciate that. Danielle, can I start with you and ask you why the resolutions were framed in this way?
Thank you, Barbara, and appreciate the opportunity to be here with you today. So you did a very good job of discussing the various proposals, and I guess to reiterate and put it simply, the proposals will help investors understand the potential climate-related risks to the companies of a transition to net zero emissions. It simply asks how the IEA net zero scenario, if played out, is likely to impact the company's financial statements. The assumptions that the company makes about climate change will have a significant and material impact on the issues that you see here, the cash flows, capital expenditures, impairments, depreciation. And we want to know how the company's existing portfolio and assets are likely to survive that transition to net zero. And without quantitative information, we have insufficient data to assess how well the company will transition, especially if that transition happens more quickly than the companies anticipate. It's also critical information in making comparative investment decisions. Increasingly, European oil and gas companies provide better data on the impact of a net zero scenario. And we would like US companies to do the same, specifically Chevron and Exxon, so that we can compare and make well-reasoned decisions. And the narrative reports, while providing some generalized information, they just don't provide the quantitative information that we need. It doesn't give enough transparency to investors. And so we're asking for more clarity.
Thank you for that. I don't know if I could ask you about why the specific reference to the IEA Net Zero 2050. I mean, I talked about that already in my presentation, but can you expand on why that specific scenario has been requested?
Sure. As everybody I think is increasingly aware, shareholders understand the need to transition. Businesses and companies increasingly understand the need to head to net zero, and that is where we need to be. And we're starting to see net zero commitments across companies, asset managers, asset owners. And so as this transition picks up speed, we want to know what does the company look like under that scenario? And it may be that it happens or it doesn't happen. I think obviously Chevron and Exxon think that it won't, or at least they've said so, but what happens if it does? And so we really want to have that information so we can make our own assessments, because everybody, every investor may have a different understanding, but this is the outside, the outside scenario that very well could happen. And it looks like we're transitioning increasingly towards that scenario.
Thank you. I don't know if Julie, I'm going to go to you next, but before we take the resolve clauses off the screen, did you want to add anything?
Yeah, the only thing I will add, and thank you again, Barbara, for having us. I think this is a great opportunity. So thanks so much. The only thing I was going to add is, I think when looking at the screen, and in some conversations I've had, somebody might say, why is it so prescriptive, or it looks so detailed? Why is that? The only thing I was going to add to what Danielle shared is that one of the reasons that we provided this extra detail in the resolve clause was Exxon, for example, did challenge the resolution last year, saying, for example, that it had substantially implemented the proposal. Also saying, for example, that it was false and misleading because there was no set standard for it to go by. And it seemed, based on the challenge, that there needed to be some additional clarity for the company. So we thought it would be helpful if we provided some prudent examples of the exact kind of things that we were looking for. This is the second year for the proposal. We wanted to make sure we got what we wanted. And, you know, at Exxon and our 21 co-filers, including Danielle, M&G, Sisters of St. Dominic of Caldwell, New Jersey, Mercy Investments, all of us seventh generation interfaith want to make sure we're getting the information that we want for the reasons that you and Danielle, I think, articulated. So it's not intended to be prescriptive. And, you know, in fact, Exxon didn't even argue that they did think it was prescriptive. They didn't say they thought the resolution was unreasonable, difficult to implement. In fact, they said that they did implement it in that advanced climate solutions report that you mentioned. So just wanted to share those pieces of info. Danielle, I don't know if you had any comments based on what I've just shared, as well as it might relate to Chevron.
No, I think that that's equally true for Chevron. Thank you.
So actually, if we go, Julie, if I stay with you for a moment, I don't know if you want to talk a little bit more about the support for these issues. I did mention, again, I mentioned that in the beginning of my presentation, how investors have been sending letters, et cetera. But do you want to touch on additional support for these issues, as well as perhaps some of the support for some of these resolutions last year?
Yeah, thanks. You know, I think one of the important things for folks on the call to just keep in mind is there really is a groundswell of support and momentum building for these issues, and really calling on companies to reflect the effects of climate change in financial statements. And, you know, I think we see this evidenced in three things. One of the high votes. So the resolution last year got a vote at Exxon in favor of 49%, and at Chevron, 48%. So I think those high votes signal real interest, and it's unusual for a first-time resolution of this kind with sort of a innovative and different kind of ask to get a response like that. And I think part of that response really came about because of the coalescing of investor networks. So, you know, I feel this groundswell of support and the momentum, not just high votes, but this groundswell is also evidenced in this coalescing of investor networks. And that helped to bring about, I think, the high votes, because you'll see, you know, pioneers like Saracen and Natasha Landell Mills started. And then, you know, quickly soon thereafter, Institutional Investors Group on Climate Change, IIGCC's report came out in 2020, giving us investor expectations for Paris-aligned accounts, really clear call to action, followed by a statement. Paris-aligned accounts, 103 trillion in assets under management, where UNEP FI, Net Zero Asset Owner Alliance, PRI, IIGCC, among others, all calling for this. And this is what's resulted in some of this tangible research. So indebted to Carbon Tracker's information, the Flying Blind report that you mentioned, detailing the lack of companies and their auditors covering, you know, material climate risks. And in response to this, you know, CA100 benchmark and alignment assessment, this is great, really allows us to benchmark companies. CA100 and this coalition of investors also really making a difference, flagging proposals. This issue was flagged, as folks probably know on the phone. And also you're going to be seeing, if you go on the website for CA100, not just flagging proposals, but also flagging votes. So we've seen recommendations, and increasingly you're going to see investors, I think, voting against audit committee members, maybe remuneration, voting against the auditor where high-risk companies are failing to meet expectations. So high votes, coalescing of investors, but just not just investors, because we're also seeing, as you mentioned, Barbara, just in terms of momentum, these accounting and auditing standard setters. And I would be remiss if I didn't give a big shout out on the SEC, because I think this regulatory change with this proposed rule really bodes well. You know, this SEC's proposed climate-related disclosure rules, if adopted, is going to require certain related information in audited financial statements. For example, great to see the SEC called for a footnote to the financial statements, right? Where required disclosures on the financial impacts of climate risk can be placed. That'll really benefit us all. So we welcome the requirement for disclosure of how severe weather events and other natural conditions and transition activities affect estimates and assumptions. And, you know, as the momentum grows, this morning we just saw ISS recommending a vote in favor for Exxon this year. So we see this tide happening, and it's really exciting.
Thank you. And it is, yes, I mean, this is really, it's amazing that the movement that's been happening over the past couple of years. And I would be remiss if I didn't also mention that the SEC disclosure, or the SEC proposed disclosure requirements, some of those, so there is already information that is required to be disclosed today. And so those are not implying that this information is not required today. And we always want to make sure that we make that distinction with listeners, but it is exciting to see these new proposals coming out. In terms of actions that these companies, that Chevron and Exxon have taken over the past year, maybe in response to this groundswell, obviously there was a change of directors at Exxon. Maybe if I go back to Danielle and ask Danielle, what actions have you seen Chevron take in the past year in regards to sustainability issues or climate related issues?
The company is taking on scope 1 and 2 emissions reductions, which we think is important. It is not yet taking responsibility for the vast majority of its emissions, which are found in scope 3. It is, I think that says a lot right there, that the company continues to work on the margins. It also is investing in some new technologies, carbon capture and storage alternatives, but that investment is very minor in comparison to the continued investment in new oil and gas reserves. So we believe that the company could be doing and should be doing better, should be moving more toward developing a plan. How will it transition? What happens if the world does indeed, the transition picks up speed, which we anticipate that it will? What happens to the company? And those are the questions that we are asking here. So it's not to say that the company isn't taking some actions, and those actions are important. They're just not enough so far. And so that is why we're asking these questions today.
Okay. And Julie, following on from that, and especially since we saw Exxon's board change, like I said, last year, the composition has changed. Have you seen any notable differences as a result?
Yeah, I mean, obviously, sort of like Danielle, it appears to be a positive sign. You know, we saw the appointment of 2 board members prior to the AGM, and then 3 installed following engine number 1's battle, not Exxon's choice. But that said, it appears to be a positive sign. There's new expertise, you know, and experience. Positive for the company to rise to meet peers by expressing aspirations on scope 1 and 2, also new. That came out in January. You know, they updated their aim of reducing emissions intensity from its operated assets. And they also launched or relaunched a low carbon solutions business. Still need more information, commitments, plans, understanding of what's to come. Similarly, unlike many of its peers, Exxon still doesn't have a target or ambition covering scope 3, even though these represent most of the emissions relating to the production and usage of Exxon's products. So I would say so far it's too soon to tell what the impact will be or how far Exxon is going to proceed. Things are too new, unclear, don't have plans, but we have to remember that Exxon's business strategy assumes continuing growth in demand for hydrocarbons for the next several decades. Company believes these conventional sources of oil continue to be important to its growth and demand. And, it's really our opinion that the company's core planning case outlined in the outlook for energy is not aligned with the goals of the Paris Agreement. It projects a 2050 future where fossil fuel still provides over 70% of primary energy, with absolute demand growth for oil and natural gas versus 2019. The audit committee doesn't talk about this. We have to look at the merits of the proposal. Barbara, we heard what's not provided by Exxon in terms of these quantitative impacts. So while there may be some positives, we still have to look at what we don't have. 49% of shareholders said they want this information. We still don't have it. You've provided ample evidence to show that. And I think so far that's insufficient. And importantly, Exxon hasn't made any commitments to provide us with this additional information. So I think this cultural shift that we're hoping for, I don't see it right now. I hope to see it at some point. But I think the jury is out, and we need to continue to use all our tools to try to get this information.
Oh, that's interesting. I mean, I think that the point is worth highlighting again about Exxon's projected increase in hydrocarbon production in the future, and the reason that this really highlights the reason that the sensitivity to, what we were calling a Paris-aligned scenario, or one of these scenarios that would achieve net zero by 2050 or sooner, is so important. Because if they're going to increase production, that's one view, but if that's management's, estimates and assumptions, but we need to understand the resilience of the energy transition as well. Jumping around.
I was
please.
going to build on that, Barbara, I think we'd be remiss to talk about why specifically the IEA net zero by 2050 scenario, just to mention the IPCC report that came out and the importance of maintaining global temperatures in the range that don't cause massive dislocation and catastrophes. And frankly, we are not moving quickly enough. Companies, investors, we need to drive our economy in the right direction if we want to have a successful economy into the future. And really difficult to conduct business and have a strong economy when impacts are happening globally, unpredictably. And so we're trying to avoid that future.
Yeah, we're seeing that. I mean, we are seeing the impacts clearly today in various ways. And I think, if I may mention, the Ukraine, I think that just highlights the importance of a transition, and for many different reasons. Moving around, jumping back and forth now, going back to the resolution, which asks for third-party audits of the information. And I suppose maybe I could start with you, Danielle, and then I'll move to Julie. So what did Chevron provide, or what did they say in response to that piece of the resolution?
Yes, so Chevron's corporate audit department conducted a non-rated assurance review of its scenario analysis. And what this isn't independent. We were looking for an independent audited statement. Assurance review has a lower level of stringency than an audit. And essentially it's not responsive to the request. And so we asked that indeed that this be an independent auditor, and it was not.
Okay, thank you. Julie, so I understand that Woodmac performed an audit for Exxon, and why was that considered not sufficient?
Yeah, so the company, says that an independent third party, Wood Mackenzie, performed what they call the quality assurance audit, and it was of Exxon's portfolio model, and it was confirming the calculations and the model functionality. That's actually not what the resolution is calling for. So for one, it's the use of an independent third party versus an auditor. This is about the financial statements. This is why we're calling for an auditor, not, Wood Mackenzie, who obviously is very smart, knows quite a bit, but this is a little different when we're talking about an auditor and performing audits. The auditors are tasked with obtaining reasonable assurance, a high level of assurance that in the auditor's opinion, it's satisfactorily free from material misstatement. And this is not my understanding of what Wood Mackenzie does for a living. So it's very important. And the proposal also recommends that that it also has confidence in the quantitative effects of using IEA net zero on key costs, estimates, and assumptions used in financial statements. So I'm not asking for an audit or assurance of the model or the functionality of the model, or was it accurately reflected in the model? We're talking about validating IEA net zero assumptions. And that's not what we received. So I think, this model review is not what we asked for. The independent third party is also not what we asked for. The level of assurance was not what we received. And, we were never actually provided with any information with the Wood Mackenzie report, for example, and the quantitative inputs, as well as the results of the analysis and the inputs that were used in Exxon Outlook. So several layers, it doesn't meet the standard in the proposal.
I would imagine that someone who has subject matter expertise should be the one on financial statement in impacts such as impairments and calculating asset retirement obligations would have been what both groups of shareholders were looking for. So I think you have mentioned this already, but I'll go quickly back to it. With respect to in the prior year, companies had challenged, I think, or opposed similar resolutions that were put forward. There was a mention of how they responded this year. I don't know, you did mention, I guess, Julie, if we start with you, you did mention that that they didn't say it was too prescriptive. Was there anything else that you wanted to add? Or what they indicated in their opposition statement? Sorry.
I'll just mention that in the opposition statement, it was interesting. The company is saying in its opposition statement, the information first, among the first sentences there, that they published the information. It's in this Advancing Climate Solutions report. The whole analysis is right there. So, in the company's mind, they didn't challenge it. It was too onerous, prescriptive, unreasonable, difficult, impossible, which were some of the challenges from the prior year. They're saying, you know what, no, we didn't. However, I think the opposition statement, when you read through it, demonstrates really that the companies failed to address the resolution because it asks for how the valuations in the financial statements would be impacted by using assumptions and estimates aligned with IEA net zero. And that would actually require the application of the IEA net zero assumptions to Exxon's current balance sheet assets and liabilities. And Exxon hasn't done this. Instead it's issued this report, which would suggest that in an IEA net zero scenario, Exxon would likely shift investments to a low carbon solutions division, not material portion of the balance sheet or indeed core operations today. And that fails to address the potential impact. So in the opposition statement, the company goes through sharing ways that it believes, it's implemented. They say that they're going to continue to grow cash flows over time through reduced investments in oil and natural gas. But this claim about what they would do in the future with new lines of business is not providing us with the specific quantitative information that we've asked for. And so there's numerous examples in the opposition statement that really are just more about how Exxon might manage its assets, still does not identify the estimated financial impact on continuing to operate these assets in a low carbon scenario. Danielle?
Okay, thank you. Thank you, Julie. I know we're cutting into our Q&A time, but I want to ask Danielle if there was anything that Chevron had said or if they opposed the resolution this year.
They opposed it last year and we were successful at the SEC, and they did not oppose this year. But what they've said is they've answered the questions. And I think it's clear just from your own analysis that they haven't. In effect, they say that they do alternatives and they do stress testing and they integrate those learnings into what they do. It's essentially a trust us type of statement. And we are simply saying, that's good, but do give us the information, the quantitative information that we are seeking, so that we can do our own analysis. What's difficult about Chevron is that it looks at the information, the assumptions that it uses as proprietary data. And that means that we can't assess what, in the first instance, their financial statements are based on, and then we don't know what the impacts are of the quantitative impacts of a net zero scenario. So I'll leave it there. So we can get to questions.
Yeah, I mean, is there any indication as to why, do they indicate why they feel that's proprietary where other oil and gas companies have been disclosing this information?
No, that is something that we continue to talk with them about. If other companies are providing that information, it becomes less proprietary and competitive. So no.
Okay, interesting. I think the last thing that I'd like to talk about would be the discussions that you've had with companies over time about these issues, like prior engagements you've been having with them, how long you've been talking to them, and anything else you'd like to add. And Danielle, if you could start with that. How long have you been talking to Chevron about this? What kind of engagements have you had with them on these issues?
So we have spoken with Chevron multiple times. We spoke with them last year. We spoke with them again this year. That we have simply come to an impasse. I do think that I was disappointed because the results were quite high. Shareholders were clear last year, and the company has not responded adequately. So that was disappointing, but we do continue to engage with the company.
Thank you. And Julie, how about you with Exxon?
Yeah, I mean, we have a long-term constructive engagement overall with Exxon, 20 years. We've been engaging the company, overall members of the Interface Center on Corporate Responsibility and series as well. But for this particular issue, we've been talking to the company for about 3 years. We've had about one 60-minute call each year. I was disappointing after the majority vote last year. 9 months went by before the company reached out. They'd already produced the Advanced Climate Solutions report, so we were not able to weigh in on, although the resolve clause is quite clear about what we want. We've not met with the board. So I think there's an opportunity for better engagement with the company. And, you know, I'm hoping that with this additional detail, with the proxy exempt solicitation we put out, you know, Exxon will be clearer about what needs to happen with this groundswell of support. But I will mention there was a resolution on this in 2017 at Exxon that got a vote of 62% in favor. So this has been on the company's radar for many years. It asked Exxon to analyze the impacts of its oil and gas reserves and resources under a scenario in which reduction in demand results from carbon restrictions and related rules or commitments adopted by governments consistent with the globally agreed upon 2-degree target at the time. This has been something that has been around for Exxon for quite a long time. I think they're quite clear about what we want, and we're hoping that we can come to an agreement with the company at some time soon and get this additional level of detail.
So this, did you say 62% in 2017? So that was, so they provided the information? Okay. there are a lot of questions in the Q&A. I am trying to figure out what might be the best since we only have a couple minutes left, unless someone has identified a question that they want to answer. I see, Julie, you're nodding. Is that you found one you want to? Okay. Well, there is
a lot of them that I thought would be perfect for you, Barbara. What about the Canadian Chartered Accountant? Questions on, I don't know, is it easier if I read some of them to you? Or?
No, don't worry. I'll read that. Let me, I'll read that right now, actually. Maybe I was wondering if you would you be happy to comment on the ExxonMobil question about seeing the IEA net zero scenario as extreme? They claim to be monitoring a variety of signposts that may indicate potential acceleration shifts in the energy landscape. Do you believe their commitment to low carbon solutions business is real and sufficient?
You know, I think that sort of goes back to one of the comments I had made earlier. I know Exxon seems very committed to that low carbon solutions business during the engagement that we've had. We need more detail. We need specifics. I think Danielle mentioned for Chevron that I think the amount that has been devoted is still quite small. I think with this low carbon solutions business just started 2021, I think far more detail is needed. I know it's very much reliant on carbon capture and storage. Like to see more on the mix. What specifically is the goal? What are they planning to provide? How does that benchmark, you know, to other companies in the sector in terms of commitments on renewables? So that's another area where I think far more details needed and we can't judge right now.
That's fair. Thank you. I had a chance to read the Canadian question. Effectively, there's a concern about auditing emissions reductions targets because there's a consideration of forward-looking. They might be considered forward-looking and is outside the mandate responsibility of auditors. I'll just say, generally speaking, what we're talking about here is the impacts on financial statements, not necessarily auditing the quality of the targets. And so I understand there is a distinction between the two. And, you know, when we're looking at information outside of the financial statements, it is important for there to be a level of understanding, expertise developed to obtain assurance. So that would be information outside of financial statements. I don't believe there is a problem with auditing any of this information because there is forward-looking information in other areas of reporting. Inside the financial statements, the impact of emission reduction targets would be, okay, well, if you have to achieve your target with carbon capture and storage or abatement, what are those costs and how might they impact your future use of these assets and profitability using these assets, or how might the impact continued use of the assets in existing asset lives? So I know that's quite a quick answer because we're running out of time, but hopefully that helps a little bit address that question. And we are out of time. So I want to thank everyone who has been on the phone listening or everyone who's on Zoom listening, but I especially want to thank our panelists, Danielle and Julie, for contributing today. It's obviously a very important topic, and it's all the work that you've put in is really, really appreciated by everyone, and I hope that things move forward in the manner in which we all hope they will. If anyone would like to keep up to date with our work, please sign up to our newsletter. Again, as I said, we have also published accounting assessments for Chevron and Exxon on our websites. I put the emails of Julie and Danielle in the slides if you'd like to contact them. And I also put my email address in the slides. So thank you again, everyone, and have a good afternoon.
Thank you
So much.